Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is January 15th, 2025, the early part of a new year. Let's get into the dashboard. I'm going to start with that. This is an interesting view. So here we are, early January, middle of January, a couple of weeks into the month, and look at all of the red. The market has been going down. It's down for the week. It's down year to date in every category. I do not remember when I last saw this. So you've got 6 equity indexes, major equity indexes, and the bond index. They are all negative for the year, 2 weeks, and the last week. So the worst is bonds. That does not surprise me because bonds have been collapsing for a long time. And the red dots, which indicate is it above or below, it's moving 20, 50, 100, 200-day moving average, or is it above? If it's above, it's a green dot, below, it's a red dot. So you can see that out of 28 possibilities on the dots, 28 possibilities of green dots, we have 5. 5 out of 28. That's a pretty negative view. And of course, in the center, in the yellow and the red box, all of the indexes are negative. So there's a little bit of green on the, moving averages, but not much. So that's the beginning of 2025. When we get to the sectors, they're mixed, but again, mostly negative. We have, again, in the yellow box, we have those for the last week that were positive sectors and those sectors that were negative. Again, mostly negative. Year to date, we only have, which is 2 weeks, we only have 2 sectors that are positive, and that's energy and healthcare. All the others are negative, and some are quite negative for that short period of time. When you get to the red dots and green dots, again, 13 out of 44 possibilities are green dots. The rest, negative. So again, echoing the same thing, negative view for the beginning of the year. This is a chart of the S&P 500. It's a line chart showing the view for the last 30 months, so 2.5 years view, and it goes up and down. But during the past month or so, you can see at the far right of the chart that it is mostly going in a downward direction. It looks to me that it is just kind of touching the 20-period moving average. It's a weekly chart, so 20 weeks as an average. And maybe it's broken through it a little bit, but not much. So I won't say it's quite broken through at this point. I put a black arrow from all the way October of 2022 to present. So that gives you a view, mostly positive. So where's it going to go from here? Is it going to break down and go on below that 20-period moving average? And if it does, in my opinion, it could go down quite a bit further. If it doesn't, it could bounce off of this and go on back up, because that's what you see a number of times the way it works. I put this on a candlestick chart, and you can see in the view of the candlesticks that they go up and down, but the red ones indicate really a week that started here and went down. The hollow ones are the ones that started here and went up. So mostly they are positive, but you can see where it's the same chart, it's just put in a candlestick form. So you can see where they are as you look toward the upper right of the chart. Again, a pretty big red one for the last week. Now, I take a relative strength chart, take the NASDAQ 100 as a numerator, and the S&P 500, the broad market, as the denominator. So growth divided by the broad market. And over this 30-month period of time, mostly it's gone up. But a lot of that occurred in the early part of the chart, whereas when you really look at the last year, it has gone sideways. So it's kind of favoring growth and then the broad market. Not going down much, not going up much. This is inside the S&P 500 are growth stocks and value stocks. This is a relative strength chart, putting growth as the numerator, value as denominator. So when it goes up, it favors growth. When it goes down, it favors value. So you can see, again, it's gone up and down, but this is a 24-month chart. Over this 24 months, you can see that mostly growth has been in favor. Now, it's up at an elevated level right now, and is it going to come on back down? We'll have to see. But even in the past 6 or 8 months, there's been a lot of up and down. The broad market, the S&P 500, which has value and growth in it, but it's all large companies, divided by IWM, which is the ticker symbol for the Russell 2000 small cap index. So when this goes up, it favors the large cap, broad market, and when it goes down, it favors small cap. So again, in a 2-year period of time, a lot of up and down. And but this last week favored large cap. Long-term government bonds, I'm not a fan of bonds, and at times they are good. When interest rates are going down, the price of bonds is rising. But what I think a lot of people have not been used to is that when interest rates go up, or the perception that they're going up, then bonds tend to go down. And this is generally anything that is interest sensitive, certainly government bonds. For maybe about 40 years, from the early 1980s to the year 2021, 2022, somewhere in that 40-year approximate time period, or maybe even before that, maybe even 2020, during that time period, bonds generally went up, because for that time period, macro now, that time period, interest rates generally were falling for 40 years. Remember where they were in 1980? Crazy high. But over that period of time, not in a straight line, but over that period of time, they worked their way down, and we got used to, financial advisors got used to, and consumers got used to the fact that bonds were solid, and they were a good counterbalance to equities in a balanced portfolio, a 60-40 buy and hold portfolio. Well, in the last 5 years, approximately, that has changed. Interest rates are now going up, or the perception is they're going up, and that means that bonds and by the way, bond yields are correlated with interest rates. Therefore, the price of bonds tends to go down. You can see that drop. Here I'm using the long-term government bond, but we could use corporate bonds, or we could use intermediate-term bonds. But the price of this ETF, TLT, excuse me, was up, if you could see the far right of the chart, was up around 170, 172, something like that. And because this chart only takes you to 150, and it's all the way down to 180, or excuse me, down to 85. So the price of long-term government bonds have come down about 50% over that approximate 5-year period of time. That is not very much help to a 60-40 buy and hold stock bond portfolio. This is terrible. 2022 was the worst in a long, long time, because bonds came down a lot, equities also came down. Neither one helped each other. So anyway, that's my view on this. I am not a fan of buy and hold 60-40 portfolios. I'm more tactical, and this is a good reason why. Okay, the dollar, now this is interesting. The dollar now, not the market, not the economy, but the dollar, look at it. This is a 4-year chart. I take it from, this is just using an ETF. Wow, that is amazing. Trajectory clearly to the upper right. The dollar strength against other currencies has been very favorable. I'll just leave it at that. I mean, you know, spending money in other countries, travel, purchases, your dollar goes a long ways. Conversely, when they spend money in the U.S. or invest money in the U.S., travel in the U.S., their currency does not go very far, or as far as it used to. Gold ticked up this last week, the last couple of weeks, and you can see that at the very, very far right of the chart. And again, this is a 2.5-year chart, 30 months, and I drew a black line to show you the trajectory of gold. Definitely moving up and has stayed nicely above the 20-period moving average. Silver is not as clean of a chart as gold is. It also had a favorable week, a matter of fact, a very favorable week, but it is below its 20-period moving average, and there's more up and down with the silver chart. Yes, it did over 2.5 years, did go up, but there was more stability with gold. Bitcoin had a little bit of a down week. You can see that at the far right of the chart, but again, over a 2.5-year period, it's done very well and is currently well above the 20-period moving average. Volatility, because you know the volatility index goes in an opposite direction from equities, so it tends to. So when equities were down this past week, as I showed you, and down since the beginning of the year, you can see to the far right that the volatility index, the VIX, actually moved up. So it's now around 19. If you look to the left, going from right to left, it went even back in the summer, it was in the teens, 12 to 13. So that's a big move up, and it shows that there's risk that is coming into the market from, I'd say, an intermediate term view, not a short term, maybe not a long term, but an intermediate term view. Asberry Research puts out their Asberry 6 metrics. Last week we had 2 that were green, not enough to flip their signal to positive, but this week, because of, again, negative week, all 6 of them went back to red. Okay, I look at the cross-asset relative performance, comparing one asset to another. And I look at the week, the month, and the quarter. So it gives you kind of a short-term to intermediate-term view. Looking at all 3 time periods, large cap favored small cap. We saw that in previous data. The U.S. is stronger than emerging markets when you use EEM as the ETF for emerging markets. High yield bonds, often called junk bonds, were performed better than high quality bonds, government bonds. And short-term bonds perform better than long-term bonds. Again, all 3 time periods. When we look at comparing the U.S., this has been very favorable to the U.S. Comparing the market, again, not the economy and not the currency, but the market of the U.S. using SPY as our proxy, comparing that to other countries, for those 3 time periods, the 3 time periods, Italy and Germany were more favorable than the U.S. However, the U.S. was more favorable than Malaysia, Japan, Hong Kong, Taiwan, India, China, Thailand, the Pacific, New Zealand, Australia, and emerging markets. So you can see it very heavily weighted toward the Pacific and Asia. The U.S. is stronger than South Korea. This is a 4-year chart and comparing SPY versus EWY, a proxy for South Korea. It is a fairly smooth chart. It does favor South Korea at the very end of it. So when it comes down, that is positive for South Korea. But still well above the 20-period moving average. Okay, gold and silver. So I mentioned that gold had a positive week. It was up 1.9% from this past Friday compared to the previous Friday. And the spot price is $2,690, and in that 1 week, as of this past Friday. And then silver was $30.97. So this is the spot price and does not include the markup. Silver went up 4.2%, a nice move up for silver. And the gold-silver ratio is now at 87-1, gold over silver. A monster box of silver is now $15,755. That's 500 generic rounds of silver, bullion, it's called. And that includes a markup of 78 cents per round, per ounce. 78 cents. Now, if you're a buyer or consider being a buyer of silver, you might look at that and go, I have never seen it that low. And that's what I'm going to say. I have never seen it that low. I was buying silver back in, and gold, I think, back in the late 1980s. And I paid anywhere from, I believe, $1.10 to $1.50 over that period of time markup. But it fluctuates. And we've seen this. I mean, we saw it almost 3.5 years ago. We saw silver, the markup on silver. It was the surging, in demand. And we saw the markup go approximately to $5 an ounce. Wow. And the silver eagles, which are, have a higher markup, I remember seeing a price of $10 silver eagle over spot. Now, there were people who paid that. But I also remember having conversations with people who said, I will never pay $10 over spot for a silver eagle. But that brings the price to $31.75 when you count the 78-cent markup, a very attractive price, and certainly a very attractive markup if you're a buyer of silver. And this is furnished to me by my son, Preston. Okay, well, thank you for watching. Hopefully that was helpful. And if you have questions or comments, leave them in the comment section below.